Welcome to the Free from Wall Street podcast, where we share how we have done over $200 million in real estate deals to create, preserve, and pass on generational wealth without the roller coaster ride of the stock market. If you're ready to start investing with purpose, visit freefromwallstreet.com. But for now, let's dive into this episode.
From operator to fund manager, Stephen Libman has done just that. He's one of the managing partners of Integrity Holdings Group. And prior to Integrity, Stephen began as a realtor and then flipped almost 1,000 properties in the residential real estate space. After getting burnout in a very transactional, highly taxed business model, IHG moved into the multifamily and self-storage space to create passive tax advantage income for themselves and their investors. Stephen and I today go through why he chose to become a fund manager instead of an operator. So why grow that operator side, building that team out, or why not, right? Why not do that versus, hey, I'm going to go become a fund manager. I'm going to focus on this thing over here. But he goes through some pros, cons, even some things around management that came around asset management that's going to be helpful to you, whether you're a passive investor or whether you're an active operator. Either one, you're going to want to hear some of that. And he throws out some things that they use to manage their fund that I'm going to go research myself. So I enjoyed the talk with Stephen about why he's now a fund manager and how they're doing in that. And he talks a little bit about their team. And a big part of who he is how they give back, which I loved hearing about. I knew this a little bit about this or about Stephen and how they operate, but it's incredible how they're functioning in this manner as well, and how they're giving back and how this is tied to their deals in a big way. Stephen, welcome to the show. Honored to have you back on the show. And you and I were just chatting a little bit about an event that we were at not long ago. It's great to meet in person. I feel like I've known you for a few years now, but it's always great to meet in person versus over Zoom like this, but welcome back.
Yeah, thanks so much, Whitney. Always a pleasure to sit down and chat with you about some stuff. And yeah, it was awesome to meet down in Florida a couple of weeks back. It is a different dynamic as the world starts to open up post-COVID to actually sit and shake hands and say hello again.
Right. Well, Stephen, you're doing some big stuff, and there's so many people that are listening that want to learn so much from people like you and that are out there doing it, making things happen. And, one big thing that, the listener would have heard from your bio and those things, and maybe know about you already, that you were an operator, right? And you started in flipping. You flipped 1,000 homes or something mad, right? Like that, just a massive business there. And so you were an operator and you were doing big things, but then you've made a switch, right? You've made a switch from operator to a fund manager. And there's so many questions around funds and operating a fund that so many people ask me so often. And I'm looking forward to getting into a little bit of that today and you helping us. But let's jump right into operator to fund manager. That thought process, let's dive in there because I know there's listeners who are probably thinking about potentially doing the same thing or at least operating a fund. But let's talk about you a little more specifically and why not be an operator anymore, or maybe go back to when that started to happen or when you started to think maybe you should do this. Yeah.
So, as an operator in single family, it's very different than becoming an operator in the multifamily space, right? It's just different skill sets that you need. So, I think there's certainly parallels, right? Where you can see I need to manage a general contracting crew and I need to manage material deliveries and things like that. But, I think a lot of the gurus teaching from the stage about multifamily are not having this conversation about asset management, property management, and what happens after you find and take over a deal. I think a lot of people are talking about how to build broker relationships and how to send offers on deals and how to underwrite a deal and how to create an LOI. And those are very important aspects of the business. But the game begins when you own a property, right? Pro formas are just that until you get into an asset and you find that, for example, we had a 66 unit where we took it over and we had a shooting 4 days later. What happens, right? You want to talk about the Mike Tyson quote of everybody has a plan until you get punched in the face. That's exactly what happens, right? You have a plan to asset manage and property manage, but then you have police there all the time. And now all of a sudden you need to have 24/7 security on staff because you didn't know that this was that bad of an area potentially, or you didn't know that there was maybe gangbangers living in your asset. And then, where's that budget coming from, right? Your pro forma budget goes right out the window. So that's just one example of many, but operationally, you need to learn how to asset manage, which is not property management, by the way. And that was a kick in the teeth for us because we thought it was the same. We thought the property manager who was telling us, hey, this is kind of the plan that we want to implement when we get into it. We were like, oh, cool. These guys have a ton of experience. They know the budgets. They know their numbers. So yeah, you go ahead and implement that plan and we'll just kind of sit back and watch you guys do it and manage to that. Well, that's not asset management. And years after the fact, we can tell you very succinctly that you need to have a plan to manage to, regardless of the third party operator. And a lot of guys, I think, eventually bring that in-house and they manage in-house asset and property management because it's easier to have your own employees doing things. And, so there's just a lot of, I think, not gray area, but there's a lot of lack of clarity when it comes around asset and property management. And that lack of clarity can very easily derail your properties. And, so we did that. We built 3 ground up self-storage facilities, about 400,000 square feet that were all managed by a third party named CubeSmart. And then we sold all of those assets last year, but then we bought a 66 unit, an 84 unit, 120 unit, and we self-managed those, and not without its challenges. Now we have since sold or repositioned all of those successfully. But it was much more of a challenge than I think anybody ever told us it was going to be. And so that's kind of the first part of this, right? Is okay, you can underwrite, you can acquire, you can even find a KP to help you sign on the debt, and you can go raise the money and then you own the asset. But then, you have 5 years or 3 years or whatever the turn plan is for this asset. And if you don't have that experience, you need to either partner with it, right? And make sure you choose the right partners, because the wrong partners are going to derail you just as badly as if you went at it alone. And that's kind of where we were at. We did a SWOT assessment a couple years back, and we said, what is the biggest threat, right? So SWOT, strengths, weaknesses, opportunities, threats for your listeners. I know you know that, but SWOTs are very important to do at least quarterly to figure out where your strengths and weaknesses and where the opportunities and threats lie in the business.
Who do you do that with?
So we run EOS. We run the entrepreneur operating system internally. We've done some coaches over the past years, but now we kind of self-implement that. And I think you build a culture of extreme accountability and transparency. You can effectively do that. If you don't have that culture yet, definitely bring in a third-party EOS coach or somebody else to help you dig through those things until you can be brutally honest with yourselves. So we did this at a quarterly, and we just went through the threats. And I just said, what is the biggest threat to our money, right? And we co-invest in every deal, and the investors' capital that we're raising into these deals. And it was us. Right. And that's just a real analysis as to what the threat was to the investors' capital. And why were we the threat? Was it for lack of diligence? Was it for lack of persistence? Was it for lack of passion? No, none of that. Right. It was for lack of experience. And even with the experienced partners that we had, it wasn't to the level of experience that I thought would eliminate that from the threat column. Right. And put it into the strength column, because that's what we're always trying to do is how do I take it from the threat and make it a strength? And the simple fact was that we were getting into a season that we're in right now. Right now, we find ourselves dead smack. We saw this coming 2 years ago, and I think a lot of guys just didn't know when. But now here it is. It's a highly inflationary season. Right. Cost of goods and products and materials are way up. Labor is difficult to find, or they're booked out months and months. And you have interest rates, right? Talking about 7 to 11 interest rate hikes in the next 24 months, depending on what source you're getting your information from, which means you could potentially get into a property and do a bridge. And then in 2 years, if you didn't underwrite that bridge refi rate properly, you're going to end up in trouble, right? So how do we hedge against that? And it's just experience. Who has gone through inflationary seasons before? Who has gone through high interest rates seasons before? And that's when we decided, okay, we're going to pivot the model. We're going to still operate the deals that we have. But if we're honest about where our strength is, it is investor relations. It is educating people about why they should get out of the stock market and into real, hard, tangible assets and some of the benefits of those things, and have those conversations with investors, not necessarily operating the property. So is there a synergy there, right? Like, where is the pivot? Go ahead.
Yeah, no, it's great information. It's great for, I think, every operator to think about, right? Every investor to think about. What you're saying right now, I just think it applies to both sides of this coin in a big way. The passive guy, the active guy, or the guy that, like yourself, that's going to be active, but you're going to be more on the fund side now versus operations. And so, I think you hit the nail, many nails on the head through what you just said. And I wanted to highlight a couple things. But initially you thought like property management, asset management were the same thing. And you figured out that, hey, really, ultimately, we need a plan to manage our asset outside of what our property management's plan is. And I can directly relate to that. We, a few months back, brought on a full-time asset manager who has just some great experience, and it's like changed our life. It has changed our life.
Absolutely.
And I'd be like, we are managing properties so much better, right? We know so much more now about our assets by bringing this person on that has a lot of experience in this area, right? We didn't bring on somebody new and think we were going to train them, right? We brought on somebody that has a ton of experience. We're paying them well because we want to ensure that we're doing our best job to manage these assets the best we possibly can. Because of what you just said, right? I mean, our investors' capital is that important, right? And it's so worth it. And so it's interesting. You talked about there's just a lot of lack of clarity around management and asset management. And I would agree, there's not been like this amazing course that teaches you how to do these things. It's so much is by experience. And you talked about, your threat was the lack of experience. And so you all navigated that in a way, where you all are like focused on like the 20%, right? You all like did that principle at a big degree here to say, we are so good at investor relations and like we're going to just hammer on that the best we possibly can. And you are doing it so well. So speak to, okay, so you decided we're not going to be an operator anymore. We're going to focus on the fund manager side. Speak to some pros and cons there you've learned that, hey, what the listener needs to know, maybe some things you didn't expect.
Yeah. So the first thing that we recognized is if we're going to be operators, we need to build out an entire asset and property management team, right? And if we want to bring that in-house and be vertically integrated, which just means everything under one roof, we're going to need a lot of employees. And I think depending on the season of life that you're in, maybe that's enticing and maybe that is not. For us, it was not. We built a big wholesale flip business before. We shut it down. We had many employees, huge payroll. It was a cash eating machine. So we were a little trepidatious to do that again. A year ago, we were like, absolutely not. Let's just be the fund manager. We can run with a lean and mean team, partner with fantastic operators. And, I think over time, as the owner, you get released from the day to day a little bit more. And then you start to see, maybe I can expand into that role, right? But it's all about seasons. So for us, we were like, well, if we build out the asset and property management team, we're going to need a bigger team. We're going to need to hire really more expensive employees that have a ton of experience. If we do the fund route, we can manage the investors. There's a lot of software programs and a lot of different programs that we can utilize to help us manage more people without having to have so many contact points. Right. So maybe you can do it. Right now our team is 6 people and we just launched our $100 million fund, and it's completely manageable with that number of people, raising the capital, managing the investor. And because just different softwares, right? We still needed to hire an asset manager, by the way, and we got a very experienced one, but that asset manager is now overseeing asset management plans from all of our other operators. So I would argue that if you were an in-house operator, you probably have one asset manager for every, 6 to 8 assets that you own. That could fluctuate a little bit, but to really be digging into the monthly numbers, the weekly numbers, the number of times that the phone rings and the number of applications that you're taking and like all of these different nuances, maybe 8, right, per employee. Our folks can probably handle about 15 because they're flagging things at a different level, right? They have a property management filter that it goes through and then an asset management filter. And then by the time it gets to us, we're seeing kind of finalized reports and we can kind of scan through those and, pick out some variations and variances that, throw a flag for us. So we still have asset managers. It's just, I think we could do it with a more condensed team. So that for me was a pro in terms of like how many assets under management can we have to the number of employee ratio that we need. The other thing is just doing what we like to do. I like talking to people about investing in multifamily. I don't like figuring out what paint color to put on the wall, right? That being said, in one of our assets, I said to the property manager that we were managing, I said, I don't want to pick out the paint color, right? And he picked out a horrendous paint color. So when I went to the asset, I was like, who picked this color? He was like, well, not you. You told me to do it. And I was like, oh, herein lies the problem, because I care about the details. I just don't want to choose the details. right? So that's know thyself, right? In terms of like what you like doing, what you're good at doing. I like talking to people about what it is that the benefits long-term of generational wealth creation and giving abundantly can do coming through these types of properties, not picking paint colors. It's not to say it's not important. It is, but I don't like to do it. So I think that's the other pro, is like being able to really niche down. And if that's what you like to do and that's where your network lies, then go do that. If you like to operate and you like to order materials and make sure that they're on site at a certain time so that your contractor can install the sinks on the right time, like go do that too. So I think that's the cons. Let's talk about some of the issues that come with running a fund. And that is, what does a fund look like? How do I manage that, right? Is it open-ended or closed-ended? Meaning, do I have a certain time frame to bring in that capital, or can I keep it open in perpetuity? If I keep it open in perpetuity, what are the risks that lie in keeping it open? Because that sounds better, right, to me, than closing it. But there's some inherent risks that lie with that too. So
if you have a good bookkeeper too.
It's super granular, right? I mean, we know some folks that run, 17,000 units, and they have a staff of over 30 accountants in-house managing all of that money. I'll give you a little trick. We use NAV, which is a third-party fund management company, and there are third-party fund management companies out there. That's all they do. They have $1 trillion under management. They manage the onboarding of the investor. They line it up with the PPM. So when you come in, Whitney, on January 1st, and I come in on March 31st, how do distributions get paid? Well, they figure that stuff out based on your PPM and the effective date and things like that. So there's some ways to get around it. You're going to pay for it one way or the other, right? You're going to pay for it in third-party management, or you're going to pay for it in employees. But I also think that third-party management, having another set of eyes on it, keeps the investors safe, right? And that's why we decided to do that. We also do third-party audits. Why would you do third-party audits? Well, in a fund, you need to analyze how the value of the fund is going up and going down, because it's not attached to a single asset anymore. Now it's attached to a dozen assets. So you have to do third-party appraisals every single year to get the net asset value to go up or down depending on how the entire portfolio is doing. Third-party audited financials. Well, that sounds expensive. Yes, it is. But why do you need third-party audited financials? It's so that everybody has complete transparency as to where the money is coming in, where the money is moving out, how you as the general partner are making money, how the deal is making money. So yeah, there's a lot of other nuance to it. But, for us, it was the right move because it was where our strength was really lying. And I think it does something else, which is, in this extremely competitive environment, it gives you the option to work with many experienced operators that have a lot more deal flow than you would be able to create on your own. And that is an actual issue right now, right? If you are out there making offers on deals, you know that people are taking down 14% IRR deals. For those of you that don't know, that's just a little bit lower than where it has been in the last couple of years, which means that there's a little bit lower cash flow, a little bit lower upside, and it's just more competitive. People are overpaying for deals in these crazy markets. Cap rates are compressed. So it's harder to find cash flowing deals, which means that people are trying to force deals to make them work so that they can get to particular return profiles that they have historically been able to see. We're not in that game, right? We much rather would find experienced operators that know how to source deal flow. And when their deal flow checks our buy box, we partner with those folks. And it gives us a much wider net to cast in terms of deal flow. So we have more deals than we have money. And that is because we partner with many different operators that have a lot of experience that are still seeing off-market deal flow. So I think that's another huge pro in this season, where it's really difficult to find decent deals.
So many things we could talk about between our operating a fund. I get so many questions around operating a fund, but I want to know your thoughts around how it affects your investors. Your investors saw you as an operator, and they were investing with Steven, right? And your team and these deals that you're doing. But now they're investing in a fund, right? And specifically like a blind fund, right? They don't know where you're going to put their capital. Thankfully, a pro that you already built so many great relationships around investors, right? Before launching this type of fund. But speak to how that's changed a little bit, or maybe even how your communication or with investors have had to change, or not like updates, but more so about like how you are presenting yourselves, now operating a fund versus being the operator.
Yeah. And, so when our investors ask us, well, why did you make this move from operator to fund manager, and how will it affect us? We tell them with a lot of transparency that we did it for them. And a lot of it was for them, right? I mean, because that threat assessment was based on our inexperience. And we're very transparent about that. It's not that we don't have real estate experience, right? Been in for almost a dozen years, but commercial operating experience, less than 5. So even though we've had successful exits and we were finding good deals and we were operating a lot, it was still to their benefit to figure out what our sponsor requirements are. So this is what we tell them. A couple of reasons that it's more beneficial for you. One is now we vet all of the sponsors, right? They have to have at least 10 years experience, at least 10 exits, and at least 1,000 units under management currently for us to even look at their deal flow, right? And that's a big deal because it shows some success, some track record. Our average right now is 25 years experience and $1 billion under management. So, we're far out shooting what our minimum requirements are, but that is the minimum for the investor and for us. And, myself, my wife, my kids, my in-laws, they all co-invest with us in these funds. So we take it very seriously as it is our money involved in the deal as well as other people's. So number one is experience, right? Now we're vetting the experience of those sponsors, and we're doing background checks and we're doing tax audits. I mean, we go deep with our partners. That's number one. Number two is diversification, right? Before I used to ask you to get involved in one deal. Well, that's fine. I mean, and I personally am a big believer that each deal self-diversifies, meaning if you go buy 200 units, you are diversified by the number of units that you have, right? If you buy a single family house, not diversified. 200 units, very well diversified. If one person moves out, you're okay with, cash flow still coming in. This is even deeper, right? This is, our goal this year is to purchase $200 million worth of assets, and that's deploying about $50 million worth of equity. And that should relate to somewhere in the vicinity of a couple thousand units. So now, instead of owning just a piece of one asset that's between 60 and 200 or 300 units, now you own shares of the company that own the underlying assets, all of them that we acquire, right? So that further diversifies you. Two is tax benefits. As you know, some cost segregation studies come in better than other cost segregation studies depending on the asset. So sometimes you have better tax benefits than you do on one property than on another, which is fine. It's just the nature of the business. Well, when you invest in a fund, now it's all equal across everybody that invests in the fund. So if I have a big depreciation schedule on one, but not so big on the other, if you invest in the fund, it doesn't matter because it equalizes out and you get your fair share of all the depreciation of all the assets that we purchased in that calendar year. And then finally, and this was a big one for us, how do we get people to compound their money faster than every 5 years? So if you give me $100,000, then you have to get some cash flow and then you get some upside, but you get your principal and a lot of the upside on the exit of the property, right? Whether that's a refi or sale. Mm-hmm. And that's when you get to compound your money. We all know that compound interest is the eighth wonder of the world. I'd much rather compound it every 5 years than never, but how do I compound it even faster? And in a fund structure, we can do what they call a DRIP, which is a direct reinvestment program. And the direct reinvestment program or dividend reinvestment program, depending on what you're reading through, is very simply that whenever those distributions of cash flow are made, and whether that's monthly, ours is monthly, or quarterly, or semi-annually, or annually, you get to decide, and you have to do it up front, but you get to decide whether you're taking that dividend as cash flow to live off of, or if you're going to reinvest and purchase more shares immediately, right? So that means every month our investors get to reinvest into the fund and they get to purchase more shares of the fund right away. It does two things. One, it helps us raise capital along the way through existing investors. And two, it helps them compound their money much, much faster for a higher blended rate of return over time.
I like that. I don't think I've heard anybody talk about that before on the show as far as, having that option. Quickly, unfortunately, we were running on time, but maybe we'll have to talk about this again. But so your investors, they get the option up front. They have to decide when they invest. Can they change that later? How that's done?
With new capital coming in, sure.
Okay.
But with existing, if you give me $250,000 up front and you decide, hey, I want this all to be cash flow to me, fine. You could say, hey, I want half of it, 125 to be cash flow, 125 to be reinvested. So you can do kind of whatever you want. You just have to do it up front when we set it up. And then if you have new capital coming in, then you can choose where we're going to put it.
Of course. No, it's great. Speak to what type of fund did you decide on? Is it evergreen? Is it open forever? Is it, closed? How did you all work through that?
Yep. So we did a perpetual fund, which is also known as an open-ended or evergreen fund. And all that means, and this is some pros and cons. And look, this is a big decision that you have to make internally. And there's a bunch of different reasons why. A ton of brain damage, about 4 months of brain damage that we've gone through to figure this out and decide what was right for us. But very simply, a closed-ended fund, you're going to say, I'm going to raise money for this amount of time and then it's done. And then I'm going to keep the fund operating for this amount of time and then it's done. And then an open-ended fund just means that you can raise that much equity, but then you can buy and sell assets kind of in perpetuity as long as people want to continue to reinvest. That's what we decided to do. The reason is, the major reason is right now in this particular environment, I do not want to have to wind down a fund just because the fund timeline is over, right? So let's say in 4 years, we're in a season that we don't really expect, where it's a bad time to sell. I don't want to have to sell my assets, right? And in some closed-ended funds, that is going to be a requirement. They have to wind down the fund to give their money back. So that can create opportunity for guys like me who's sitting on capital and saying, hey, okay, you have to wind this down. Well, let me buy it right at a distressed price. The other part of it is that historically we found that people don't want their money back, and I think there's this kind of common theme about how long do investors really want to keep their money at work? And that's a problem, right? If you go, I'm going to do an open-ended fund and we're going to keep it open for 10 years. And Mr. Investor, the expectation is 10 years. Look, I don't know what's going to happen tomorrow for lunch. I'm not going to lock up my money for 10 years. What's interesting is if you give people the option every 3 years, they will give it to you for 10 years, right? It's just they don't feel locked in. So the idea of an open-ended fund just allows them to continue to reinvest. But there is also an annualized plan where they can come in and say, hey, I want out of the fund. But there's a 3-year initial lockup period. And then every year we give them the option to take money out of the fund. So we did the open-ended fund because, one, we don't want to have to wind down. And two, we expect that we're going to be purchasing for a long time.
That leads in well to what predictions do you have for the real estate market over the next 6 to 12 months? Obviously, you're in a way of buying or expecting to buy, right, and invest large amounts here. And any thoughts that you have around just what's happening in our market over the next year or so?
Yeah, and I think coming from the wholesaling world and flipping world back in residential 10 years ago has taught me this, is that there's always deals. When everybody else is screaming that there's no deals, there's deals, right? You might just have to work a little bit harder for them. You might have to look under different rocks, but there are always deals to be had. You have to make sure that you live within your own buy box and not allow yourself to move off of your own standards. That being said, I think that, people are, you talk to some people that are saying, this is a bubble and it's going to pop. You talk to some people that are like, economics are economics, and there's still a lot of historical evidence that inflation actually increases real estate values over time. So I'm of the mindset that inflation increases real estate values over time. I think that inflation rolls to the renter, essentially, right, as the business owner, and continues to pass on. Just like you're paying more for groceries right now, renters are going to have to pay more in rent over time. I think inflation will continue to get hedged a little bit by interest rate hikes. But I think overwhelmingly, by and large, you will see that populations are still moving in different areas across the country where there is a huge housing shortage. And if you're buying or building in places that there's a huge housing shortage and you're underwriting to the proper metrics, then you still have a very long window for good investment opportunities. This is why we got into commercial real estate in the first place, right? I think real estate historically outperforms the S&P with volatility of stock markets, like hands down. So that's why we got into real estate in the first place. Why we switched from residential to commercial real estate boils down to really just this one statistic, which is in 2007 and 2008, when the bubble popped, you had almost 7.5% mortgage default rates on the residential space. In multifamily, it was 0.4%. Right. And you can look that up. That's a statistic that's real in 2007 and 2008. So you're talking about, what is that? I mean, that's like 15 times, right, the opportunity of mortgage default in residential. So not all real estate is created equal, right? Especially in apartment buildings. So we like this as a hedge against inflation and a recession-resistant asset class over time.
We could have a long conversation just about that. It's great information right there, Stephen. But speak to what's your best source for meeting new investors right now?
We have a new director of investor success, and he's got 25 years with wealth management in top 5 wealth management firms that you would recognize. And he manages a lot of retail investors that have historically only known the stock market. So, these are families that are between $1 and $100 million worth of net worth that have historically invested in the stock market, know that there's going to be volatility there, and they're looking for some hedge against inflation or some tax benefits. So he's been a big key. We were on a podcast doing shows like this has always been great. But at the end of the day, I think there's still a very small fraction of the population that knows that the 401k and the investing in the stock market is the only way to go. They think that that's it. They don't know that there's other options. So it's just beating the drum, right? And getting on the megaphone and letting people know like, hey, that's not the only way to do it. And we've had some success with that.
What are some daily habits you're disciplined about that have helped you achieve this success?
Yeah. So I caught some heat on Facebook not so long ago because, I just let people know gently that I bought $200 million worth of real estate in the past 10 years or so. And I've never gotten into a ice bath, and I've never done 75 hard. And I think people took that as a dig on them, but it wasn't. It was just letting people know that, everybody has their own things that, motivate them and keep them grounded. And, no, it's not a dig against health. It's not a dig against, Wim Hof or any of these other guys, but it doesn't need to be a torture chamber for you to be successful, right? You don't have to wake up before. I have 3 kids that are 8, 4, and 2. Ministry is a big part of our lives. And I can't wake up at 4:30 in the morning, right? So I try to wake up at 6. I try to make sure that we're going on walks and bike rides and stuff and staying active at least 30, 40 minutes a day in some way. But in terms of really daily disciplines that I think are giving their biggest return on investment, it's just thinking, right? So if there's a great book called The Road Less Stupid, and if you read it, yeah, it's fantastic, right? I knew you'd have
I recommend it often on the show. I got it right here.
Yeah. So good. And the biggest takeaway from that book that I have taken is to sit without a phone, without a computer, in a separate chair, which now I have in my office, and just sit with a notepad and think through some of those things. You could start with just a SWOT assessment, right? Like, what are we doing well? I love the quote in the book that says the best time to sit and think and pick apart your ideas is when you are certain about something. And it's when you have certainty that you need to really pick that thing apart. So I love just being able to sit and think. I have it on my calendar for 30 to 45 minutes every single day to just sit and think about processes in the business that are broken, some things that might be things that we can automate, right? Some systems or some automations that we could put in place for replicable processes that we don't need to continue to take the manpower and put into place. So I think that's the highest return on investment. I think making sure that you are sitting and thinking about the business is huge. So in terms of daily habits, I wake up every morning and I go into the sunroom with a cup of coffee and read the Bible for 15, 20 minutes. And that just kind of sets the tone for the day for me. That's probably my ice cold bath or, 30-minute workout in the dark. For some people, that's kind of the relation that I make to it. But yeah, we stay relatively active with the kids. I mean, it's impossible not to. And just making sure that we're reading and praying. And, we're Christians, we're believers. We think that God is the CEO of our business, and we try to bring major decisions to him first and pray about it as a team before we make any major decisions. And I think that has been the reason for all of our success, frankly.
No doubt about it. Appreciate that, Stephen, in a big way. I love how you said, daily disciplines that have had the highest return and some things you laid out there. It doesn't take cold showers to make it happen. But if that's your thing, it's great, right?
Exactly. No hate.
I like warm showers, but anyway, that's great. I appreciate that. And even speaking through, the importance of those things that are important and keeping the main things, just like time in the Word and time with your family. And hey, that time with your children in the mornings or afternoons is, just crucially important, right? And just the priority on that. So I appreciate that. Speak to quickly how you like to give back, and then we'll, because I know it's such a big thing for you, just like it is for me. And so I love just hearing about that and how you're doing that.
Yeah. So a couple of years back, we started a donor advised fund. And so I was trying to think through how do we give more abundantly now before we quote unquote make it? I think probably most of us have like a make it number, like, once I make $1 million, I can give away X. So there's two parts of giving, right? One is a tithe And that comes from your salary, and everybody on our team tithes, right? If they're saved, right? If they're Christians. So we give, I give 10% of what our income is as a family to the church as kind of our tithe. Offerings are different, right? That's over and above what the 10% is. So everybody's like, oh, you give a percentage. Cool. That's like a tithe, right? It's not, it's over and above the tithe, which is called an offering. And I was like, how do we give more abundantly now before we make it there? And it was pretty simple through some prayer that we can start partnering with nonprofits today. We didn't need to wait. And we just needed to grow in the grace of giving and say, how do we start today? So we started a donor advised fund. The first deal that we bought, we said, okay, 1% of all the cash flow and 1% of the upside is going to go into the donor advised fund. And then the next deal we did 2%. The next deal we did 4%. The next deal we did 10%. The last deal was 20% of all the cash flows and all of the upside. And that's a huge deal, by the way. So it will relate to just incredible, way beyond what I ever thought we'd be able to give to get given through the donor advised fund, which trickles down to, so far, I think we have 16 nonprofit partners that are either supported on a monthly or annualized basis. And it's been absolutely incredible. And what I love about it is that it's the heart behind the business. And it's also operationally how we dictate what we're going to do on an annualized basis. So unlike a lot of businesses that go, what is our goal income for the year? And how do we back that out with number of deals or number of doors or number of transactions? We go to, how much are we going to give away this year? And then we start backing that out, right? How much are we going to give away? That trickles down to how much profit. That trickles down to how many deals and transactions and doors and all of that. And man, what a cultural shift it has been for our team. They get to participate in a huge way in eternal things, not just these things. And of course, we're all trying to make a great living for ourselves and our family and create generational wealth. But the heart, the focus, the BHAG of our business, the big, hairy, audacious goal of the business is to give 80% of all of our net profits away through our donor advised fund at some point. And that doesn't have a timeline to it. We're going to do it as fast as the Lord allows. But man, the team gets on monthly calls with these nonprofits and they hear about incredible stories of what we're doing, digging wells in Western Africa, saving girls from sex trafficking in the Philippines. We had we are actively right now supporting pastors driving out of Kiev with women and children. And we had to buy some vans and we had to buy some bulletproof vests and bulletproof blankets. And there's about 60 people a day getting extracted with these pastors. And that's all funds that came from our donor advised fund. And man, I'll tell you, it changes the dynamic of how you do business.
Man, appreciate you sharing that, Stephen. Yeah. Wow. Just even thinking about, if you're having to wear a bulletproof vest to do what you're doing today, you're just the way you think about life and think about your day just changes drastically. Right. I mean, just totally. Like, oh my goodness, it helps put things in perspective for us a little bit in our comfortable homes this morning, drinking our coffee right before we get our day started and the troubles that we think we have. Now, I have been in areas where I have had on bulletproof vests and I'm thankful for it at that time. So I'm so thankful that now we don't have to do that. But I love that we can support those who are in that situation and that you're doing that. And even sounds like how you're operating this fund, you left the operator to become a fund manager. Sounds like, now you're finding nonprofits kind of similarly, right? And you're helping fund just great nonprofits that are already have those systems in place as well that are, you're helping support that cause that you believe in. So I love that. And what did you say, 13 or 16 nonprofits? 16
so far. And yeah, one of our employees has gone almost 20 hours a week to just manage the donor advised fund and the needs of the nonprofits, which has been incredible to see. That's what her heart is about. But she deals with investor relations and helping onboard clients and getting paperwork done for them to onboard. And then at the same time, she's helping find what the current needs are of the nonprofits and sending the money there. Sometimes I don't even know when we send money until we have like a monthly meeting about it. And it's like, oh, we were able to donate how much? And yeah, it's very cool. It's starting to really take on a life of its own.
That's awesome. Well, Stephen, always a pleasure to catch up with you and hear what you're doing right now. You're a great operator and you're doing things at a level that I love seeing guys do and, and just operating in a way that is unique, I think, very unique, which makes you stand out and in a good way. But appreciate just you being willing to share, the operator to being a fund manager, some pros, cons, things we need to be thinking about as we contemplate operating a fund or not, or man, even the asset management piece and property management, there's some highlights there. I mean, like it's worth, whether you're a passive investor or active, going back and listening to some of those things that Stephen brought out. So grateful again, Stephen, for your time. How can listeners get in touch with you and learn more about you?
Yeah, go to integrityhg.com, sign up for the Investor Club. You'll get told about, get a bunch of free resources. We also have a podcast called Free from Wall Street. So go ahead and tune in. And, we talk a lot about the things that we're talking about here. We talk about investing in relationships, not just real estate, and some other things, and the donor advised fund updates and things like that. So if that's of interest, go ahead, check that out, and, feel free to reach out to us.
Thanks for listening to the Free from Wall Street podcast. If you like what you hear, leave us a rating and review and let us know what you think.